We're at 62 participants.
Okay, well, we'll get going then. Well, welcome to the Private Equity 101 webinar hosted by Catholic Investment Services. Thank you for joining us today. My name is Tom Lanctot, and I am privileged to serve as Chief Executive Officer of Catholic Investment Services. Joining me is my colleague, Zayla Astarjan, who has done a great job organizing this program and is at the Zoom control panel. Enormous thanks to our all-star panel, who will be introduced shortly. Today's format will be conversational, with private equity and agri-food legend Dave Taiclet serving as moderator. There will be plenty of time for questions after the formal part of the program, so when prompted, please use the Q&A feature, not the chat feature, the Q&A feature on your Zoom screen to submit a question. Everyone in the audience, other than our panelists, will be muted, and the call is being recorded. Catholic Investment Services was founded by some of in the investment industry's most respected leaders to address the investment challenges faced by Catholic organizations. We are a Catholic nonprofit serving other Catholic nonprofits and hope this webinar provides some useful take-home value. Zayla has provided biographical information for our speakers, but I want to add a few additional comments. Our moderator, Dave Taiclet, has achieved great success in private equity as both a general partner and as the CEO of a series of successful food and agribusiness companies, including some noteworthy turnarounds. After graduating from Notre Dame and before entering Harvard Business School, Dave served on active duty for 4 years as a captain in the 4th Infantry Division of the United States Army. Like many of you, Dave has been an active Catholic fiduciary, including recent service as chair of the investment committee for St. Mary's College. A member of the Candy Hall of Fame, Dave is also a lock to be inducted into the CIS Hall of Fame. CIS was privileged to partner with Jackie Rantanen and her colleagues at Hamilton Lane on CIS's Catholic Impact Fund, which recently completed its fundraising. As head of Hamilton Lane's product management group, Jackie has been an innovative and effective advocate for socially responsible ESG and impact investing in the private markets. Don Wehremann overcame the handicap of being a St. Louis Cardinals fan to build a successful consulting practice at Pavilion Mercer, where he advises a number of Catholic and other nonprofit institutional investors. Donna is a proud product of Catholic education from kindergarten through his master's degree, majored in theology, taught 4 years at a Catholic boys' high school, and remains an active volunteer for Catholic organizations in the St. Louis area. Thanks again to this exceptional panel for contributing your time, talent, and experience today. I'm now pleased to hand the program over to Dave Taiclet.
Thanks, Tom, for those introductions, mostly overstated, I think, a bit, but thank you. Thanks to all of you, the people that are participating today, for joining us. Thanks for all you do for the great work in being stewards, advisors, thoughtful investors of very valuable and mission-oriented capital. So we want to thank you for doing that. Whether you're a volunteer or this is a chosen career, thanks for all you do. I think it's appropriate that we start with a prayer. And this prayer was given to me by my friend, Sister Ann Pajakowski, with the Sisters of the Holy Cross. As some of you know, the sisters, as their shield was on the previous slide, are great friends of Catholic Investor Services and its mission. So in the name of the Father, and the Son, and the Holy Spirit, this prayer Mary Ann sent me is a prayer for a pandemic. May we who are merely inconvenienced by this pandemic remember those whose lives may be at stake. May we who have no risk factors remember those who are still vulnerable. May we who have the luxury of working from home remember those who can't work from home and have to make difficult choices. May we who have the flexibility to care for our children when schools close remember those who have limited options. May we who have to cancel trips or vacations remember those that have no place to go or can't afford a vacation. And may we who can settle in and be safe in our homes remember those that have no homes. During this time when we cannot physically wrap our arms around each other, let us find ways to be the loving embrace of God to all. Amen. And thank you to Sister Mary Ann for that. So again, good morning to some, good afternoon to most of you. Again, I'm Dave Taiclet. Our format today will be very straightforward. We realize your time is valuable. We'll cover some broad-based topics and information about private equity. And then we'll open it up to question and answer and try to field as many questions as we possibly can. As Tom mentioned, we've got an all-star group of panelists today. Don from Mercer Consulting, Jackie from Hamilton Lane, and we're here to talk about private equity. And our webinar is Private Equity 101. So we're going to try to unpack this subject and learn from each other. We want you to walk away with the basic concepts of private equity. For a number of institutions, this is a missed opportunity, investing in private equity. Sometimes private equity is deemed complex, a mystery. And what we hope to do is to help demystify private equity and present it as an opportunity for some institutions, maybe not all, but for some institutions. All right, so let's jump in. Jackie, we'll start with you. Thank you again for being on the panel. So what is the difference between public and private market investments? And in essence, what's the purpose of private equity, and just how big of an opportunity is private equity?
Yeah, they're great questions. So let's just start at the beginning. And some of this might sound really fundamental, but let's go with that as a baseline, and we can always dig deeper. So at its core, private equity is a way to invest in private companies rather than the public companies that we're all so used to. A private equity fund is the mechanism in which to invest. And think of that as a professionally managed investment vehicle. What makes private equity and private markets unique is the process. It's a long-term asset class where value is created over time. And we'll talk a little bit more about that. But it's important to highlight the opportunity set that you asked about. It's a common misconception about private equity that you're investing in small, maybe niche companies, maybe only startups, and that there aren't very many of them. And it's untrue. It's actually a target-rich environment. In fact, the number of private companies with revenues over $100 million is over 6 times that of public companies of the same size. And that's in the US only. So you add to that the rest of the world, and you get a sense of the opportunity set that is the private equity investing universe. And interesting to note that the number of companies going public is shrinking. Many companies are choosing to stay private. So without a private markets program, investors are missing exposure to a huge part of the investing universe. And a lot of times these are companies that help drive innovation, transformation, and therefore economies.
Yeah, great. So we'll stick with you, Jackie, here. So big market, you kind of outlined the size, big opportunity to invest. Can you elaborate on the structure of private equity? You know, where does the money come from for private equity? We'll discuss in a bit the different styles of private equity, but I hear general partners, I hear limited partners. Do we invest all this money in one big chunk like we do in a public market, or is it drawn out, over time? And can you kind of explain kind of the structure?
I can. So let's start with the investors. They are called limited partners. The reason they are is because by and large, the structure of investing is into a closed-end limited partnership. So investors are referred to as limited partners. Historically, that was just large institutions. Today, it includes a wide range of investors, from public and private pension funds to endowments and foundations, family offices, and it continues to expand. Now, these limited partners can invest directly into a private equity fund. The managers of the private equity fund are referred to as general partners. So think of them as the ones who scan the marketplace and invest in the private companies. They typically invest in a number of private companies within one fund. So within one fund, it's not uncommon to have anywhere from 20 to 50 companies, depending on the strategy. So for an investor to build an appropriately diversified portfolio, they would have to invest in several underlying funds. Now, there are other structures. There's fund of funds as ways for investors to spread out their commitment and gain further diversification. But before I talk about how the private equity investing works, which you asked about, I want to define a couple of terms because these two will answer some of the questions. So we throw around terms like capital commitment or commitment. That's the amount of capital that an investor agrees to provide to a private equity fund. Not exactly the same thing, but capital contributions are the amount that the investor contributes to a fund to pay for investments and expenses. These contributions are made over time. And then distributions are the capital that comes back to investors from the sale of investments. They include the original investment, the costs associated with that investment, and then hopefully some profit. But let me come back to the process that makes private equity unique. So it starts with an investor making a commitment to a fund. Now these are long-term partnerships, typically 10 years. So the first kind of 4 to 5 years of a fund's life is where the fund manager, the general partner, will call capital down from the investor's original commitment in order to invest in private companies. And they build the fund or portfolio with those companies. During that time, during the time from buying a company to exit, they are actively working with those companies, adding value. It depends on the strategy as to exactly what they do, but that is the most important part of what is happening, that they are buying companies and they are actively adding value. So it could be anything from growing revenues, enhancing operations, acquiring other companies, and taking different actions. And then once they've added that value, maybe it's year 5 or 6 of a fund's life, they seek to exit the companies. That may be a strategic sale, an IPO, a merger with another company. And that's when the fund manager returns the capital back to investors. Like I said, the original costs and a profit. But it's a continuum of activity. Sometimes partial realizations can occur as early as year 2 or 3.
Yeah, great answer. I think just as an example, my equity fund is a growth equity fund. We've raised 200 million. We're early in our process. We've only deployed 30 million of our 200 million and invested in 4 companies. So it gets deployed over a series of time, as you stated there. And that's kind of a classic model.
Yeah, I mean, you can almost picture it like a bell-shaped curve, right? The investing activity occurs over time, and just when it hits, kind of peak exposure is when some of the first investments mature and get exited, and then you slope it back down. So the misconception about illiquidity and the commitment is an important one to talk through so that investors understand the difference between, making a commitment and what their kind of cash flow experience and performance experience might feel like.
Right, and we'll unpack that a little bit further in the latter part. So let's turn to you, Don. A number of us on this call sit on investment committees, large dollar investment committees, small dollars. Where does private equity fit, and how big of a pool of money does an entity need before considering private equity? And then as an advisor to people, should private equity access be part of the criteria we have when we hire advisors? And interested in all your thoughts on that.
Sure. So while size certainly has to play a factor and is important, I actually think an organization's liquidity needs and requirements are probably more important. As a general rule, if you wanted to set a minimum, you could say, 25 million in investable assets is just kind of general rule of thumb. However, as I said, liquidity becomes more important. A lot of the pools of assets that we're talked to, these institutional pools, have very, very long investment horizons. A lot of them maybe into perpetuity, or at least 20 plus year investment horizons. And so with that, they do have the ability, while it seems complex, as you said earlier, to take on some illiquidity in that profile, in their overall portfolio construction. And so that's one of the things, there has to be an education process and an understanding about what liquidity needs are. And that comes and starts with that portfolio construction process that we sit down and advisors will sit down and do and walk through with these institutions. Understanding what do they need on a quarterly, annual, or even kind of project out 3 to 5 year basis for liquidity. And then, as Jackie said, then that helps kind of really position what kind of private equity investments you could be making. When we think about where it fits overall in the portfolio, Jackie talked a little bit about, public equities and how big of a universe there is in the private space. We certainly would allocate away from public equities into the private equity space. We think about it in a couple different ways. One is it's a return enhancer overall relative to the public equity market. You basically you think about it as you're locking up money for an extended period of time. So there's an illiquidity premium that you should expect overall. And that's when we're building it in, that's what we expect. But as you alluded to, it's not all pulled at once. So you do allocate over a period of time. And so that money stays in the public equity market and it draws down over time as portfolio companies are identified. So therefore, it provides an additional level of diversification. It's a massive market out there, as Jackie said, and there's a big opportunity set. And so not having any exposure, if you can take on that illiquidity, is missing really a big opportunity to diversify away from just kind of day-to-day public equities. Going back to kind of the last part of your question and thinking about advisors or on a future basis, private equity access or some level of partnership is, I think, an important part. When we think about returns and what we see on a go-forward basis, we're in this kind of very low yielding environment. If we think about fixed income yields, and therefore kind of our overall prospect for public equities has come down. I think probably most of the folks on this call can relate. Budgets haven't shrunk. Spending needs for the various missions haven't gone down. So we need to find ways to kind of overall boost and enhance return. And we think private equity, if you can do so, is a great way. And so from that standpoint, having an advisor with a robust team or private equity process, I think is really important. It doesn't mean that you have to allocate. It doesn't make sense for every institution. And we've had a number of discussions with folks where it doesn't make sense at this time. But having that ability and the ability to educate and think through it as a committee is an important part of that overall portfolio construction process.
So if I had to kind of summarize a few things you said there, which are really important, 25 million is kind of back of the envelope size, but liquidity of the funds is probably the predominant issue about whether private equity is appropriate or not. The funds are drawn over time, so you can kind of understand that. And then you may not need private equity now, but having advisors that have the ability to deliver that to you when it does become appropriate is very important.
I think that's an excellent summary, Dave.
Okay, great. So I think maybe jumping in a little bit, Jackie, we've talked about the need for private equity in the overall capital markets, and there are a lot of private companies that need access to capital that may not be able to get it from traditional sources, and that's how the private equity funds manifest themselves, and each one of them have a different kind of strategy or a certain focus or expertise. So we hear things like buyout funds, growth equity funds like my fund, or distressed debt, or mezzanine and real estate and real assets. And then you talk about venture capital and seed capital and angel investing and early seed. We could probably spend 2 or 3 hours talking about all the different styles. I think what's most important for all of us that sit on investment committees is maybe understanding some of these and how they play out. So do you want to spend some time talking about that? And Don, I'll have you jump in after this too and add as well on these different styles that you see.
Yeah, absolutely. It's interesting. It's probably unfair that, you know, the private equity term is used. It's really an umbrella term of a lot of different types of investments. So you have managers with expertise in certain types of strategies. So you mentioned buyout. Buyout is probably one of the more familiar terms. Think of that as buying mature cash flow generating companies. You look at a different end of the spectrum, and that's startup and early stage companies. That's where venture capital comes in. Growth equity is somewhere in between those two. But then you also have investments in companies that are stressed or de-stressed. And you also have kind of the more traditional real estate that certainly people are used to when you think about buildings and housing and land. You have real assets like agriculture and timber, natural resources, which can span energy to minerals. Infrastructure, which we're hearing a lot about today when you think about data and communications, transportation, renewable and traditional power and energy infrastructure. And then importantly, add to that private debt, which has become a real growth part of the market recently. And so that spans everything from debt origination to mezzanine and distress, which I mentioned. So we think it's really important that people understand, as you say, that there is a range of strategies. And so when you're building a private markets portfolio, we shouldn't even just call it private equity. You want to make sure that you understand the different strategies because they bring with them a different opportunity set. And so a portfolio that includes a number of the different strategies will include a wide and diverse set of underlying portfolio companies within those strategies.
Yeah, really good. And Don, when you're advising people, is there kind of a go-to strategy that to start someone off with? I assume you don't immediately put them in a, mezzanine or distressed debt, but maybe something. Any thoughts on that? I don't know that data where people go to, but just thought I'd throw that out there.
So I mean, I want to say, just to expand a little bit on what Jackie said, I think one of the things that we first, I'll say, have to unpack or change is people's mindset that when they hear private equity, I think a lot of folks immediately go to venture, and they think very high risk. This is either going to be a home run or a zero. And while I think there is some really good venture strategies out there, we really build and think about private equity portfolios for clients as just that, as portfolios. So we diversify across strategies, much like you diversify within a public equity portfolio. You don't own just, large cap companies. You own large, you own some small, you own international, and you diversify across strategies, because just like in public markets, there are cycles, and there's for those various other strategies as well. So that's how we think about things, and we kind of build it more. We think about it from a diversified portfolio, from a diversification standpoint.
Yeah, great. So just to maybe amplify a little bit. So on the venture side, and Jackie, you mentioned this, it tends to be earlier stage companies where the private equity group is underwriting technology risk, product development risk, trying to understand what the probability of having this get developed. On the other side, you have, as you described, the buyout funds and buyout. They're underwriting kind of valuation risk. These tend to be more mature companies. And then on the in between, kind of the growth equity side, they're underwriting a lot of execution risk around, hey, they've gotten through the product development and early stages. Now they're trying to grow their company. And so the use of funds here, I think, are really important in helping develop and understanding the risk profile. And venture tends to be a little on the riskier side than the buyout side. Would you agree with that?
That is right. And as Don said, it's really about understanding an investor's appetite for risk and liquidity and all of the pieces that go together to help select the right types of investments and to build the right type of portfolio, because there's a place for the different strategies with the right managers, but not necessarily for every investor.
And then within each of those kind of broad strategies of venture, growth, buyout, there's a lot of times underlying strategies. You touched on those a little bit, such as it's a technology fund or it's an industrial. Do you want to comment on that at all, and kind of the underlying strategies there? It can also be important as I sit on these investment committees, and it's like, well, I'm not so sure we want to do that kind of investment, but we want to do other things.
Right. You know, within the expertise of a strategy, buyout, or venture, many managers have a sector expertise. And so these are the types of things that investors need to understand as they're looking at opportunities and as they're building out a portfolio. So you might love the idea of technology, and you might be nervous about healthcare, or vice versa. Or if you're a healthcare company, maybe you have enough healthcare exposure in your business model that when you're building out your investment portfolio, you want to complement it differently. And so it's really about understanding and about making conscious decisions and understanding, if you have a portfolio, each opportunity that you bring in, you want to see how it adds to the mix. So your example is a good one. Maybe you have a technology specialist fund, and that's one area where you're really interested. If you bring in a generalist fund, are they leaning towards technology? A lot of investors are. And so, you know, really either partnering with someone that can help you understand the different pieces, or having your own expertise to understand how to underwrite, how to make decisions around your portfolio exposure, and how to pick the right managers is an important one. And I would say that, you know, if you look at the opportunity set today that versus 20 years ago, it is expansive. And so that might make it feel really complex for investors, but this is exactly what we want in a mature asset class. You want the ability to make those very tactical investment decisions, and you want to have the ability to select managers that have that expertise as well.
Great. Don, anything you want to add on to that discussion about the focus areas of the different styles?
Yeah, I think the notion of sector specialists, I think, is a really critical point. You know, we tend to really like kind of industry experts, or folks that maybe have industry experience before they moved into that private equity side. If you think about it from that perspective, if somebody's really good in food and hospitality, you don't want them all of a sudden making an investment in a tech company. And those are the types of things, people that stay down the middle of the fairway, because I'm a golfer, you know, down the middle of the fairway, right in their zone, is really is good. And having that discipline, maintaining that discipline, is something we really value highly.
Yeah, great. So, Jackie, so how long are these commitments? We make a commitment to a private equity fund or fund of funds or some kind of private equity strategy. I mean, do we start making money right away? I mean, it just sometimes you hear these things about how much money is being made in private equity by investors, and it just seems sometimes too easy. So, can you walk us through how does this happen?
Absolutely. So first, I think it's best to think about the life cycle as a 10-year life cycle for an investment. And so think about the investment phase, the value creation phase, and then the realization phase. And with that, the return profile for most funds, we'll talk about some differences in a minute, but for most funds is often referred to as the J curve. And that's because early in a fund's life, when capital is just being drawn down, the valuations are relatively low because capital has been drawn down, they've been invested in companies, there's been some fees paid, and so it often can result in a negative return. And so, you know, it takes some time for the managers to execute on their value creation strategy. But once that value creation shows itself and the value of the fund appreciates, first it's on paper, so you get some unrealized appreciation, and then it's through realizations. Important to note though, once exits are made, that capital goes back to investors. And so it is not as if you pay all of your capital day one and you get all of your capital back on year after year 10. It really is a continuum, but it's important because certainly it's easy to intellectually explain the J curve, but in my 20 years of private markets investing, I've yet to meet an investor who is happy to experience it. So really, it is about managing both expectations, but also portfolio construction to try to mitigate or minimize that J curve.
Yeah, it's funny you say that, Jackie. I'm not a private equity career person, but early in my private equity, I did get one of those calls from an investor on the J curve, like, "Hey,
I bet you did."
investment, and we've already, but it's explainable. But Don, going back to you, Jackie touched on J curve a little bit. When we're thinking about portfolio construction, and we hear a lot about vintage years and the exit strategies. Jackie touched a little bit on that, but can you speak to how do we construct a portfolio that makes some sense when we put J curve into account, the vintage years? You need to walk through that. I like wine, so I kind of get vintage years, but portfolio companies, exit strategies and such. So.
Yeah, so the first on the J curve piece, you're right. We walk through it. We have education slides on it, but the experience is something different. One of the things when we think about portfolio construction, we've talked about the different strategies, but there's also within those different strategies, there's also some different structures. So secondaries is an example, or co-investments. So these are secondaries. You can think of them as private equity funds that are being sold to other investors because they either need liquidity or they're just done with that life. Co-investments are where you're actually investing in direct portfolio companies kind of alongside. Both of those can really help mitigate that J curve, or at least shallow it out. And so when the time is right and when those opportunities present themselves, we like to incorporate those into kind of an overall portfolio, the portfolio construction for a private markets portfolio. On the vintage years, so just like Jackie was saying, you don't want to invest all. If you make a 10% commitment, you don't want to invest 10% in 2020. You spread that out over the several years because there is cycles to it, and you don't. As much as I wish we could predict what years are going to be the best years, and we would just pile it all in. We don't have that knowledge or ability. We don't know what companies are going to become available. And so you invest over a series of several years, and that really goes hand in hand with Jackie's notion of this continuum of the investment. So you're investing across vintage years. You're diversified across kind of strategies and companies, and as that private equity portfolio gets more seasoned, or starts to get closer to its target allocation, you start getting those distributions. So you start getting capital calls as well as then distributions, and then that becomes this kind of almost living thing within itself as you kind of move along that. And so I think that vintage year diversification is really important. The other piece, just it's not necessarily anecdotal. Private equity has been around for a long time, but oftentimes some of the best vintage years to invest in are following really periods of market stress or distress. And so oftentimes those are the hardest times to say, I want to go illiquid, or I want to add an illiquid investment. You've just, lived through, use the 2008 period. You've just lived through a period where the market was down, organizations were stressed, but really some of those investments made in that year or two after are some of the best ones. And so that's the other piece. We don't know when that turnaround is going to happen, so we diversify kind of across those periods. We talked a little bit about diversification across portfolio companies and strategies, and so we look for that. I touched on that. The exit strategy is a little different. So, you have to think of these as true long-term investments, and so, the ability to exit them from a force standpoint is typically not ideal. So you need to be able to hold on to that. And we talked about what the return expectations are. We want to earn a premium relative to public equities, but we look for that exit, and we rely on kind of the experts in those specialty fields to know and identify when those ideal exit periods are for investors.
Great. Your point about some of the better performing vintages are post a stressful period. I mean, from the private equity side, a lot of that is around valuation and how you value things. And typically when you go through a stressful time, valuations tend to recede, offering opportunity to invest at a lower point. And maybe the entrepreneurs or the companies have a more moderate or modified view of valuation at that time. And so that offers opportunity in the marketplace at times. So we make, so Jackie and Don, so we make a commitment to private equity as something important to our overall portfolio. And we've been through, I've been through a lot of investment committee discussions where some it's well, we're a big group, we have a large group of money, and then others where it's a small amount of money, maybe not appropriate, but something that gets discussed. But we make the commitment. It's something we want to do. We get something interesting constructed. How do I measure success in what I'm doing? And so what are some of the key metrics? And we'd like to define some of those terms as we talk about them so people get familiar with, when they look at records of private equity groups, they can understand the terms and what they mean by those kind of things. So Jackie, do you want to go first then on this?
Sure, absolutely. So you're right, and it's important that people understand that measuring performance in the private markets is different. And it's for a number of reasons, but part of it is because of the time period. And so we use a number of different metrics. One, the most commonly referred to one is internal rate of return, so IRR. And that is the annual return. So remember, this is, investments held 5, 6, 8, 10 years. And so you're looking at the return over that time period. But importantly, very importantly, we also like to look at what's called the MOIC, or the multiple on invested capital. And so you want to make sure that you're getting a good return, but you're also getting more cash. And so is it a 2 times MOIC? Is it a 1.8 times MOIC? Is it a 2.5 times MOIC? Those are other metrics that are important. So too, during the investment period, is that the distribution pace per invested capital. So sometimes some investments have a lot of unrealized value appreciation, but there's no distributions back. That could be well and good when the exits are actually made, but understanding for some investors, as Don had mentioned, that liquidity piece is important. So it's about understanding all of these different factors so that we can look at how a fund is doing both on an absolute and a relative basis. A lot of what we do is compare performance manager to manager, sector to sector, and strategy to strategy. And we use that vintage year as a baseline.
So Don, you want to add anything on that, on measuring success and how we measure it? We talked about MOIC and other types of measurements. And I would like both of you, one of the questions we have is, what's the cost of private equity, and where do I find that, and how's that figured in? So you can answer the question first, Don, but then we want to talk about costs. There's a couple other questions up we'll try to get to as we see them come up, but I think the cost element is applicable to this discussion we're having right now.
Sure, and we use a lot of those same metrics as we're evaluating kind of individual partnerships or even fund of funds that Jackie referenced, internal rate of return. But a lot of this does go back to what is the purpose of it? When you think about it in a broader portfolio context, what is the purpose? Why did we allocate to it? Did we allocate to it for return enhancement? Did it accomplish that goal? What did its return profile look like relative to public equities? So we'll use kind of public market equivalent is the common one that we'll use. And so if you would invested capital in the S&P at the same time you were investing capital and having capital drawn, what did that look like? And so because at the end of the day, you made a decision, we made a decision, and the clients made decisions to allocate away from public equities, and the reasons behind that need to be justified. But the other piece, and I think this is a really important one, is to make sure you're looking at it over the investment horizon. This is something that can be very tough to evaluate on a quarter-by-quarter basis. You will get, and I'll use this most recent year, as bizarre as it's been, for as a prime example, in 2020 we started with the first quarter, and we all know the public equity market sold off pretty significantly, down 20%. If we look at our private equity portfolios on a March 31st performance report, it probably looked phenomenal because you were actually getting delayed marks. And then you roll forward and you get a second quarter like we got, where the market was up 20%, and you're catching up with first quarter private equity valuation. And so that timing can cause a lot of consternation among committees. And so it's important to really understand that and make sure you're accounting for that and looking forward over a long investment horizon. As we said, these are 10-year investments. Evaluating their success on a quarter-by-quarter basis can lead to some more consternation inside of a committee meeting than it need be.
If I can just make one point to that great example that you had, Don, the public markets were down 21% at the end of March. And while the timing was different, but the equivalent of the private markets at that same, the same period of time was more like 8 to 10%. And so that's a very real, very timely example of how different these kind of portfolio exposures can be in a broader portfolio.
Yeah, great. So thank you. So any last comments? I'm going to take a question here and pull Tom in to talk about how does one apply Catholic social teaching in private equity, and how does CIS manage the Catholic social teaching part? And Jackie, you may want to jump in as well. And I know there's some questions regarding ESG factors and others. So we'll try to unpack those questions that were put up there. I think, right, Zayla?
Yep.
Okay.
Please come with all your questions in the Q&A button. We will try to answer them.
So Dave, you want me to try and take a crack at that question?
Yeah, I think it's, we're all interested in if we put money into a private market and understanding how we can still live up to the way we're going to have the money invested. How does that happen? So
it's as the millennials like to say, thank you for asking that question. Let me answer that in the context of our Catholic Impact Fund, which recently completed its fundraising. CIS has developed a very robust and distinctive socially responsible investing process. And our original focus was on screening to avoid doing harm. And we used the SRI guidelines issued by the U.S. Conference of Catholic Bishops, and we are continually refining those principles by incorporating new developments like Laudato Si, the papal encyclical, other developments. For private equity, we partnered with a firm, Hamilton Lane, that understands and has experience with faith-based and socially responsible investing. And so, a great advantage of private equity is the ability to make positive and intentional investments in areas that align well with Catholic SRI principles. So the Catholic Impact Fund is focused on energy and environment, health and wellness, financial empowerment, and community development. So, I think those are good areas where we can really focus and apply in a positive way our Catholic investing principles. Another good example of how private equity can help is it can offer Catholic investors who are looking for a way to pivot from fossil fuels and invest through the private markets into new emerging energy technologies and other climate-friendly investments. So, at least through our fund, we're able to invest in companies that not only do these great things, but that we think are great businesses with offering attractive returns. But I think Jackie might want to comment more on the ESG, how they incorporate ESG and impact into their investing.
Absolutely. And so there's a number of ways to think about this. At its core, ESG, so energy, society, and governance, are factors that all investments should be looked at through that screen. So think of them as potential risk factors. So understanding how an investment could impact positively or negatively the environment or be impacted by the environment. Same with society. All investments should be looked at through a governance lens. And so we look at ESG just as an embedded due diligence practice, if you will. But as Tom said, you know, there's an opportunity, particularly in the private markets, and we see this through a lot of investors, and Catholic investors are one great example, where the desire to align investing activity with the core mission or values is growing. And so the private markets, because of their control nature, are really well aligned and really well positioned for that type of investing. And so, as Tom said, you have the ability to make very clear the types of companies or the types of sectors that you want to either invest in or to avoid. And then you can build a program around that. And that's been something that we've been doing for a long time across our history with investors. And so the Catholic investors have a very specific set of guidelines that they are working with. Other investors have other guidelines that are core to their organization's mission. But again, the private markets allow you that flexibility, particularly when you have the ability to look down into the portfolio companies and understand the investments being made.
And I would add to that just on the private equity side, there's a somewhat of a continuum when you look at the funds. Some funds may or may not have an ESG strategy. Others are way far out to where it's a very stringent requirement on portfolio companies to report back on a number of ESG criteria that are put in place that the fund tells their investors, this is what we live by and this is what our portfolios, our companies are going to do. And I think that's kind of
that's exactly right. And I would say that it's, you know, you certainly hear a lot of discussion. If we were in Europe, it would be old news. You know, investors in Europe have been embracing particularly the environment for some time. And so I do think you're right to point out that it is a continuum, and investors have the ability to kind of participate in that continuum where it makes the most sense for them.
We have a question on private equity costs, which we didn't cover, and the other one on UBTI. So Jackie, maybe do you want to start with the UBTI question and cost, and then maybe Don can continue.
Sure. Well, you know, I think it's fair to say I'll answer the cost question first. That investing in the private markets is expensive. It has been expensive, but that part of the return evaluation is to factor in that expense. And so we said it a couple of times. We talk about returns. All of the expenses that investors pay need to be paid back before profits and before the general partner gets paid. So think about generally in the private markets, the terminology is typically 2 and 20. So 2% management fee and 20% carry or profit participation. Honestly, it typically spans 1.5 to 2 and 20% carry. But before the managers get any of that profit participation, all of the expenses have to come back, as well as typically a return hurdle. So think of it about 8%. So unlike the hedge fund world where the managers get to take some profit off the table on high water marks, this is only on exit and only on realization.
Yeah, I think it's important to understand that most of the fees come back before there's sharing or carry along the way.
Great answer. And so the question about UBTI was, do you use an offshore investment vehicle to avoid UBTI?
I would say most managers have a blocker onshore and offshore vehicle for those very reasons. And so investors, you know, for a number of different reasons need that, but it's very common to have a blocker for UBTI. So yes, I would say that's very, very common.
Don, did you want to add anything to that about the costs or UBTI?
The only thing I would add is certainly it's something that we factor in when we think about and do evaluation. We spend a lot of time looking at cost structure for various private equity funds, and I think it's an important part. I think while 2 in 20 sounds like a lot, there is a lot of times common incentive in the notion that you're only the general partner is sharing in it over a specific return rate, which also tends to be north of where our forward-looking expectations are for public markets.
Jackie, you might just mention for a minute some of the ways that your firms try to address costs and through some techniques where you've tried to reduce the overall cost to the investor.
Yeah, so there are a couple of things that we do, and one is that we have a long history of working with the general partners in the private market space, and so we work very hard to negotiate the best standards, including fees and governance issues. Because we have a wide-ranging client base, we are often able to speak on behalf of all of our clients before we invest into a particular fund and really be able to negotiate on behalf of those clients. And so that does give us some leverage. I think the other thing that's important, Don mentioned this, the participation in co-investments and secondaries is another way to average down the costs of participating in the asset class. So not to get too much into the weeds, but you do pay less than that 2 in 20 often on co-investments. We rarely pay fees or carry on those types of investment opportunities. So factoring those into a portfolio can average down the overall cost. Secondaries, if you think about, as Don described, instead of investing day 1, you're investing year 4 or 5, your expenses are typically lower and you're getting returns back quicker. So you really can be an active manager and an active participant in the expense piece of a portfolio. As Don said, it's part of what they look at, it's part of what we look at as we're making our own investment decisions on behalf of clients.
Yeah, one of the things I heard Scott Malpas say in a previous CIS webinar was about getting access to the best PE private equity managers and how that happens. And can maybe Jackie or Don speak to that as well? And what does that mean?
I'm happy to start. Unfortunately, for many, the private markets is an unfair kind of access point. So unlike, subscribing to some public market funds, there are limited capacity, if you will, to the private markets funds. They're closed end, so an investor will raise a certain amount of capital, and for the best of them, they often have more capital than they want for a particular fund. So they have the luxury of turning investors away. So being able to know who the good managers are, being able to evaluate them, as Don said, but then being able to actually get allocation is a big part of the value equation in the private markets. So being able to work with a partner who has those relationships, who has the ability to know when investors or when the general partners are coming to market and be able to secure allocation is a big piece of what investors benefit from when they're working with different partners. I don't know if you had anything to add.
Yeah, Dave, I think this goes back to one of your first questions, which is kind of the importance of having, should you factor PE when picking an advisor? And I think this is a prime example as to why. It doesn't guarantee you that you'll be able to get access, but there is a large number of private equity managers out there. And when we think about that, having access is important. Having the ability to, especially when you're, to Jackie's point, it's a little unfair. It's the larger the check you write, the better access you have. So when you think about that, kind of $25 to $100 million kind of investment pool, finding a good partner that has a lot of that access is going to be really important for getting exposure to some of those managers.
Don, I know we're close to the 2 o'clock mark, 3 o'clock mark. Quick question. How should Catholic institutions feel comfortable in adding illiquid investments to their investment policy statements into their portfolios. Could you could you talk about that for a minute?
Yeah, I'll be brief, just in recognition of people's times. But I think the important thing is to step into it slowly. You know, I've heard some of the previous ones where you talk about in universities and endowments having 30-40% in private equity. They didn't get there overnight. They eased their way and stepped their way into it. When you're talking about Catholic organizations, one of the things, it all flows up to the top, and so we try and make sure that everything is understandable. There's good rationale. You're being good stewards of Catholic assets. And I try and, if the Archbishop gets asked a question, he should be able to answer it without feeling really uncertain. I mean, so we spend a lot of time educating and going through and making sure that everyone's on board and comfortable.
Dave, Jackie, Don, thank you so much for this very valuable program. I learned a lot, really great. And we're deeply grateful for your contributions today. Special thanks to our audience for joining us. In the coming days, we'll be following up to share a copy of our new ebook on private equity for Catholic institutions. And with that, again, thank you for joining us, and please all be healthy and safe. That ends our call.
Thank you. Bye-bye.
Thank you, everyone.
Bye.